What is going on, you guys? Welcome back to another video. Today we're filming this video out of Powell River, British Columbia. I'm joined with Dad. I guess I'm joining you today.
You are. It's so nice. Brandon and the family is up visiting us, and we are reviving one of the most popular series on our channel that we haven't done for a long time. It is the
Stock Battles. It's been a while since we've done Stock Battles, but this is the series you guys know where we basically both pick a stock that we're liking at the moment. You guys vote down in the comment section below which one you prefer, which one gets your vote. I say let's get after it. There's a lot of stocks we could be talking about right now with the markets since our last stock battle. But let's dive in. I'll kick things off, guys. If you enjoy, give this video a thumbs up. My pick, Dad, is the company Nike, ticker NKE. I was surprised to look at this because I hadn't actually peeked at it in a while, down 50% off highs. So like a lot of the market, really starting to kind of get hit here. I've personally wanted to own Nike stock my entire life. I've never once owned Nike stock. And that's, for a sports fan like myself, it's just, this would have been a very, very clear selection for me. It is kind of starting to get into that range where I would personally feel comfortable pulling the trigger on it to add to my portfolio. I actually just bought a new pair of Nike shoes this week.
Oh, did you? Okay.
Yeah, so a new pair of running shoes, and I'll put them up on the screen. They're nothing special.
I'm guessing they're pretty expensive. That's just why you think that there's a lot of profit in the company, right?
Well, these ones, surprisingly, I went for a cheap pair, $135, which is actually cheap considered some of them were $300. But it's funny, I was actually comparing between a New Balance shoe and then a Nike shoe. And I just thought the New Balance is such a dad shoe. It's such a old school shoe. And I was literally about to buy them. And it was $35 cheaper, the New Balance shoe. Yeah. And then I just thought to myself, you just want to wear Nikes. Everyone wants to wear Nikes, and that's part of the allure of why I think this company is so special. But let's talk about the company in particular. What's new? Well, the recent quarter was mixed for sure. On the revenue side, at earnings, they were pretty much flat, pretty much came in right at expectations. But really what was notable and what is the big concern that's floating out there is the inventory problems. So may have heard here, but inventory ballooned 44% year over year as the economy continues to slow. Of course, this isn't just Nike specific, but this was really what I felt to be quite notable out there. Really looks to be a point of concern right now. Even announced that they're going to be dropping prices to kind of offload some of this overstock that they have. This to me is very much a short-term concern. That's kind of what I want to talk about. Why I like Nike. There's kind of you think long-term, you think this is very much a short-term blip because in general, Nike's a company that I've never had concerns about when it comes to the balance sheet. Nothing concerning on the long-term debt side. This is just an overall very well-run company. And with the 50% drop, the valuation today, I would argue Nike still trades at a premium price. I'm not trying to say that Nike is like a dirt cheap company. That may be the difference between yours. I don't even know what stock you're talking about. I'm not trying to say that it's dirt cheap. And I think Nike's one of those few stocks that always kind of trades and commands a premium because it's such a powerful company and such a high class quality stock, kind of like maybe a Starbucks or a Visa. They just trade at a premium. It is in a range that I believe is now offering value, but not extremely underpriced. Do you get what I'm trying to say here or no?
Exactly what you're saying, yeah.
I'm liking the range, but you are still paying a premium because it is a high quality stock. And that's something that I'm very happy with. Looking at a forward PE basis, like I said, it's been cut in half with the share price from basically 50 times to 28 times. Morningstar is undervaluing the company by about 31%. So like I said, even though you're still paying a decently high forward price earnings ratio, you're still in a range where I think it makes sense to start looking at. Why I like Nike, honestly, it comes down to how special Nike has developed the company in regards to their marketing, in regards to that aura that surrounds the company. At the end of the day, that's the type of thing that is very difficult to replicate because, Nike, like many other companies out there, like thousands of other companies, sell shoes, they sell t-shirts, they sell pieces of clothing. But there's something about Nike that just, it's intangible. That's something that makes them special. And that's something that I believe will really essentially widen and keep that moat, if you will. Although this is essentially a commodity-based business. I don't know if you consider it a commodity-based business, but it's just clothes.
It's commodity.
It's commodities,
sure.
Clothing.
Yep.
But even, for example, just one of the pieces I saw recently was they just signed 5 high school athletes. Not even professional, not even college level, high school athletes like LeBron James Jr. or Bronny James, DJ Wagner, which are a couple of these all-star high school recruits, even a few female ones. They've already had such a successful model of approaching these influencers and marketing in the sense of kind of finding what's cool in our world. And clearly they're just kind of doubling down on that. It makes people kind of proud to wear Nike, right? It's it truly is a status thing. And I don't think that's ever really going to change. That's something that can't be replicated. At the end of the day, I do love investing in industry leaders, and Nike in the apparel space, there's no other like it. It's at the top of the game with the share price today at $88.66. like I said, depending on how the market reacts, I'm not saying this is a bottom or that there's not more to go, but it is in that price range where I'm starting to really look at it, even for my own personal portfolio, something that I haven't been able to say for the past number of years. But yeah, that's my pick for the video today.
Well, the last thing I want to do is support your pick, Brandon. But the last video I did, it talked about blue chip investing, and Nike was on that list of companies I referenced, not directly, but as one of the companies that the Harvest Fund that I covered owns. And all of the qualities, the characteristics you just spoke of are reasons why a company like Nike is a company to own. Now, I'm going to talk about, because this is a battle. Right?
It is. At the end of the day, I appreciate that.
Here,
I appreciate that.
So I don't want to sway any votes your way, but I want to talk about the company that I chose to talk about today. And we're talking about sort of, I think, a timely selection for the times that we're in right now. And of course, as you know, markets have been very volatile. You talk about Nike being down, cut in half, basically. The company that I've selected for the stock battle today is called Realty Income Corporation. The ticker is O, and I gotta love that ticker. It's O. Now, Realty Income Corp is a U.S. REIT, and in fact, it is the fourth largest REIT on the planet. They've got over 11,400 properties under management right now. 78% of their revenues come from non-discretionary or low price point entities or businesses. And that's really critical when I talk about times that we're in today. We're looking for stability. We're looking for reliability. 94% of the total rent is resilient to market downturns. We're going to look at how they've reacted in recessions over their history. And a lot of people, myself included, are saying, hey, we may be on the verge of a recession. Or a lot of people are saying we're in a recession right now. So I'm looking at the battle right now as this may be a time to pick up on this company. When we look at REITs, the first thing you got to look at is the quality of the assets that they hold, because you want to get paid. Just look at this list here, the top 20 clients that they have. A lot of these names like Walgreens, Dollar General, 7-Eleven, Dollar Tree, FedEx comes in number 5. And you can see on down the list all of these contracts here. Very, very stable companies securing rents. When you look at the diversity across industry, grocery stores, convenience stores, dollar stores, and even those are the top sectors they operate in. But you can see down this list a lot of good, strong industries that they rely on. From a credit worthiness perspective, let's look at their credit ratings. And we can see they are actually one of only 7 S&P 500 REITs that have 2 A3 or A- ratings or better by Moody's, S&P Global. And you can see their debt load that's coming between now and 2033. Very well spaced out. Nothing that would be, even if we hit a hard time right now, nothing that's going to really hurt them from a debt perspective. They're going to be able to make the payments. Now, this is what I sort of touched on earlier about recessionary times and getting paid. When you look at the occupancy, you look at the people, you look at the payments that they've been receiving during these times. Their portfolio occupancy, even if we go back to the tech crash back in 2000, the credit crisis 2008, the COVID event in 2020, during those times, I believe it was around 96% was the lowest that their occupancy fell. So we always hear in these tough times about, people are fleeing and they're not going to be using businesses anymore or offices. Well, this is a pretty good example of the staying power that this company has. Quick talk about their dividend here. They're currently yielding an attractive 5.3%. They've had 628 consecutive months of paying that distribution. So that's 52 plus years, 100 consecutive quarterly increases in that dividend. So they've had 117 increases since 1994. It is part of the S&P 500 dividend aristocrat group, and we all know, for those of you who invest in dividends, that's something that it says a lot about a company and the staying power that a company has. If we look at the dividend on a chart here, we can see the mean dividend is 4.35. They're currently trading at about 5.3. So even if we just look at that as one of the metrics, we can see that there's the price has dropped to the point where it's raised that dividend. If we revert to the mean, there's an indicator that the price may have to rise to bring that dividend back down into normal range there. So that's one positive. A knock on a company like this is, let's look back over the longer term and see, well, they've earned 37% since 2013, so that's not very good return. If you're looking just at the price, yes, but of course a company like this distributes a lot of its earnings out as distributions, as dividends, and so we can see in a case like this, if you overlay the total return, it's 121% over that same time period. Now, I'm going to address a concern. I know a lot of you are saying, If you know the company, they have a payout ratio currently of 325%.
Boo.
So, yeah, boo. I mean, are you nuts? All kinds of thoughts as to why would you invest in a company that, the payout ratio is 300% plus. This is a REIT. And as most of us know, as a lot of us know, you don't measure the payout ratio on an earnings ratio. In a company like this, in an entity like this, because of the way that accounting works, you use funds from operation or adjusted funds from operation because of all the depreciation, the amortization that an entity like this undertakes. So when you look at an adjusted funds from operation chart, which is represented here by the gold line, you can see that there's $3.90 a share in that funds from operation versus the $2.92 dividend payment. So that brings the payout ratio down to about 75%. And if you look back over time, you'll see that there's always that margin of safety in there. Why am I saying right now it's a good time to buy this? Well, first of all, a couple of things we can look at, just the market cap today versus the enterprise value. So the enterprise value, I just feel, is a more thorough way of valuing a company. We look here, market cap of about 34 billion, enterprise value just north of 51 billion. So there's some room to move there if all of that value is realized from a technical perspective. And this is actually where recently O came back onto my radar. I know we've talked about this in a previous series that we did. This company was one of the higher yield companies. But right now, from a relative strength industry, this popped up on my radar screen because they're now trading in what's typically considered to be oversold territory. They've been there for a little while now. When I compare that to the MACD, we can see that signal line has just ticked as a crossover there. And just a quick, short little time period here, but when we look back earlier in the year, we see two previous occasions where we've seen exactly the same thing. We've seen that RSI come down, we've seen that MACD crossover and that signal line there. So that's just a sign that maybe, again, we're at a time where it's optimal to buy this. From a price target perspective, the Wall Street is saying, well, there's about a $72 price target on this. It's trading at that 60-ish. So there's some upside potential that right there, right now. When I look at today, in the environment that we're in economically, we look at safety, we look at reliability, we look at predictability. I think that for this stock battle, I love Nike, don't get me wrong, but for the battle purposes here, I think O is the way to go this time around. So thoughts, Brandon?
O is the way to go. I like that little thing that you said there. Yeah, that's a great pick. What I'm thinking this entire session here, Dad, was, technically I'm on vacation right now. Mm-hmm. And I thought we were going to prepare a short little brief video, so I just had a few notes. You came in with all the guns blazing so that you could win this battle, but
well, just FYI, I'm sort of on a permanent vacation. Okay, so
right, fair enough. That's fair enough. No, yeah. That's jam-packed with great info there, and there's not really a single thing I would argue with. And as you mentioned, we've touched on Realty Income on the channel in the past because we are big fans about it.
And I would say we touched on it. We did a series on dividend yield or high dividend type
building
of
a dividend portfolio. I believe it was.
Yeah, and we should put a link up here probably for that because that's something that if you're interested, go back and review it. And there's some great information there. O being one of those. But anyway, that's neither here nor there. We're talking about this. So your vote.
Yeah, your vote will really tell us what counts, but I do really like the pick, Dad, just to be clear.
Thanks.
So I think they're both
too nice to each other, eh?
Yeah, I like yours, you like mine. Hey, maybe we'll make it easier for them. Why not buy both? And place your vote for both if you like them.
And they complement each other.
Yeah, I hear Ava bouncing around over there.
Oh God, can you get her? And here she comes. Thank you for bringing your family up here for this this little couple for the weekend. We had a bit of a hiatus, with the new worlds that we live in with the stock battle and the joint videos. And so hopefully, for those of you who said during the time off, we want another one of those videos, here you go. So look forward to seeing your votes for Realty Income Corporation.
Yeah, right. And Nike. Well, yes.
Well, good. That's it. That's a wrap.
If you guys appreciate the content, like you said, just keep dropping thumbs up.
And if you want really good steady income to look after your family, then vote for
Nike.
Okay. Bye,
awesome,
everybody.
guys. Thank you.
Thanks. Bye-bye.